This video series is dedicated to understanding the national debt and how it directly affects the value of our money, our retirement funds, and our investments. Let's begin by understanding how the government ends up getting into debt and who lends it money. When the government spends more than the taxes it receives, it borrows money from other sources, such as other government agencies and foreign countries. When they borrow money, they issue Treasury bills, Treasury notes, and Treasury bonds. For those of you that don't know, Treasury bonds pay a fixed rate of interest every 6 months until they mature. They're issued in a term of 20 or 30 years typically. Treasury bills are short-term government securities with maturities ranging from a few days to 52 weeks. Some agencies, like the Social Security Trust Fund, take in more revenue from taxes than they spend. These agencies then invest in U.S. Treasuries rather than put their cash in the bank. They redeem their Treasury notes for funds as needed. If the government agency collects their funds and the federal government doesn't have the money, they either raise taxes or issue more debt to raise the cash. Debt owed to other government agencies is called intragovernmental debt. The second type of debt is public debt. This is what the government owes to Treasury investors. These investors include people in the U.S., international investors, and foreign governments. If you invest in a Treasury with a plan to redeem that for cash when you retire, that means you just lent your money to your own government. That being said, many people still wonder, why not just print money instead of going into debt? The short answer is this: if the government keeps on printing money to fulfill its obligation, we will sink the economy because our money will lose its value. Here's a more detailed explanation. Let's take a potato as an example. Let's say it costs $1 a pound. Since Americans love potatoes, each of us buys 1 pound of potatoes a month. That means the value of the $1 is 1 pound of potatoes. Let's assume that the government prints more money and doubles your salary. Now you can buy more pounds of potatoes. However, others have doubled their salary, so everyone wants to buy more potatoes now. The demand for potatoes is up. So the suppliers of potatoes increase their price to, let's say, $2 a pound. You're paying more for the potatoes that you used to. Now, I know what you're thinking. Let's just produce more potatoes. I have no doubt that will happen, but we have to hire people to work in the farms, and the higher demand for workers will likely raise the wage of that cost. Also, workers will see inflation around them and want higher dollar wages, so they will continue to buy as much as they can. Money is in fact a facilitator of exchange between people and a middleman in a trade. If goods could trade with goods directly without a middleman, we would not need money. If you print more money, you simply affect the terms of trade between money and goods and nothing else. What used to cost $1 now costs $2. That's all. Nothing fundamental or real has changed. Now let's understand why and how the government gets into debt. Let's discuss who the biggest debtors of the U.S. government is and how it could possibly affect your money, savings, and your retirement.